What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to talk about one stock which dropped a little bit over, I think 10% after hours. And the question is it finally time to start buying this company? This is a stock that I've personally admired for quite some time. It's been on my watch list for over a year, but it's been trading at a very, very high valuation up until, I would argue, this point. But I think there's more to go. So hope you guys enjoyed this video. As always, if you find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. Would love to have you on board. I did open up a couple more spots since it's the first week of the month, and you can access all the members-only private videos. So we'll be going over very important technical levels, including support resistance levels, intrinsic value spreadsheets, members-only private videos, buy and sell alerts, options alerts, early access to the MoneyVest Pro platform, trading view charts. There's a lot of other benefits included with the link down below, and would love to have you on board. Also, do connect with me on Instagram if you want to. Username is going to be @castwrp. Link's going to be down below for that as well. I do post some interesting and helpful stories and posts and whatnot. So again, if you want to connect with me there, link's going to be down below. So the company that we are talking about today is going to be none other than Fortinet. And Fortinet is a cybersecurity stock that has been trading at I would say a very elevated valuation for quite some time. You'll notice that the all-time high sits at well over $81 per share. But if I bring you over to the 4-hour chart, this is the decline. Actually, it was down 17%, not 10%, down 17%, trading down to $47.55 because of a guidance miss. But they did beat on earnings per share, slightly missed on revenue expectations, and guidance was a bit of a problem of slowing down in terms of that growth, and as a result, a 17% decline. This is the second decline that we're seeing for Fortinet. I did a video around this time as well. Basically mentioned that I think it's still got more room to the downside. I think we still need to hold off before jumping in. And of course, it consolidated sideways for 90 days, and then another earnings comes out and it's down another 17% to come down to $42, $43. So I'll take a look at this in more detail. We'll do the complete analysis. There's going to be a couple gaps, one gap from previous earnings, one gap created today, and it's going to most likely open in and around here at $42, $43. And I'll go over some of the technical analysis pieces for the chart as well. So when it comes to Fortinet, it is a large and growing cybersecurity company. The addressable market for secure networking, security operations, and universal SASE also growing by about 20% for this particular market from 2023 to 2027, 14% for this security operations, and 9% CAGR for secure networking as well. So by 2027, they see the overall market that they operate in to grow to almost $199 billion, right? So that's going to be up from about $125 billion in 2023. These are the numbers. So third quarter billings came in at just shy of 1.5 billion. That's up 5.7%, and you can kind of see the slowdown in growth for the company, right? That's actually one of the reasons why the stock is down here, because we are basically coming off a very nice 40, 50, 30, 20% growth to now a mid-single digit, right? 5.7. Revenue was up 16.1%, which I would argue is still pretty good, but nothing compared to what we have seen in the past. Again, 25 to 30, 35% growth. Product revenue was actually a decline, 0.6%, and service revenue was up 27.6%. So that's actually good because, this creates a lot of that recurring revenue for the business and really makes it a higher margin business model. This right here are the overall numbers. Again, we got gross margins at 76.9%, so those are actually pretty stable. Operating margins sitting at 27.8% at just over $370 million. And net income came in at $323 million, which if you compare this to the third quarter of 22, it's actually up pretty nicely, right? From $262 million. So if you do the math, 323 divided by 262, we're looking at a 23% growth on a year-over-year basis for the company. And shares outstanding have basically gone down. So diluted shares outstanding have gone down from 836 million to 791 million, and from same time last year, 798 million down to 791. So the company is doing some share buybacks as well that we are going to account for in our analysis. And earnings per share obviously up to 41 cents per share, up from 33 cents same time last year. So those, again, I would say are pretty good numbers. So revenues grew, profitability grew, We did see share count go down. Balance sheet is still pretty solid, which we'll take a look in just a minute. This is going to be the geographic breakdown. So what we'll see here is every single geography grew 16%, 15% in Americas, Europe, Middle East, Africa, Asia Pacific. And this right here is going to be the contribution margin for each geography. So majority of the revenue is still coming from Americas of almost 41%, Europe, Middle East, Africa 38.4%, and Asia Pacific at 20.7%, which is slightly higher on a quarter-over-quarter basis for the company. Now, in terms of number of deals, they closed about 4,700 deals, of which 835 were over 250,000, which is about slightly flat from a year-over-year basis. Number of deals that were done over 500,000 was slightly higher to 367. A number of deals over $1 million, about 145, and that was a slight decrease from same time last year, about 153 as well. This right here is going to be adjusted free cash flow for the third quarter. So really, it's a business where, as we progress through the year, cash flows start to increase starting from first quarter to the last quarter of the year. So I wouldn't be surprised if we do see that very similar trend follow, where cash flows continue to increase again in the fourth quarter being a very strong quarter, and then the first quarter of next year being also substantially better than what we are seeing at the moment. This right here is going to be last trailing 12 months of cash flows. We'll account for this $2.2 billion in our analysis when we are calculating the fair value. And this right here is actually one of my favorite slides because it shows us the compounded annual growth rate for the business for product revenue, service revenue, and total revenue. A 14-year CAGR of about 24%. So in other words, the company's grown revenues by over 24% consistently for 14 years. Not an easy thing to do. And if you take a look at the last 3 years, from 2020 to 2023, they've grown that number at even a faster clip at just under 27%. So that's going to be that growth rate. And 27 to 2020, about 20%, 2013 to 2017, about 24.9%, and 2009 to 2013, about 25%. So the growth has been well over 20% for revenues over the last several years. But Wall Street is kind of concerned that this growth rate is going to start slowing down, and we're now going to be working with 10%, 12% growth rates for the company. And I will account for that. I will simply account for a very simple 10 to 12% growth rate for the company, and that's exactly what we're going to use for the intrinsic value. This right here is going to be the guidance, and this is where majority of the problem happened because the guidance was not as strong. 10.2% growth in billings and about a 20% growth in revenue for the entire 2023 is what they're expecting. Net income is going to be close to about $1.25 billion after accounting for both the shares outstanding and the earnings per share, and the margins expected to be steady at around 76-77%. Gross margins and about 27.5% operating margins for the company. Now, in terms of balance sheet, we are looking at about $3 billion of cash and short-term investments, with about long-term investments sitting at really very, very small 1.5 million. So overall, it's got about close to $3 billion worth of cash and marketable securities, with long-term debt sitting right over here at just under $1 billion, right? So the company's got more cash than debt on the balance sheet, so it's very well capitalized. And on a current ratio basis, we got current liabilities at 3.6 billion, and current assets are going to be sitting at about 4.7 billion. So we got more current assets than current liabilities, so pretty good current ratio, pretty solid quick ratio, and good cash debt ratio for the business as well. Now, in terms of valuation, this has been the biggest concern for me, is that the valuation was always a little too high. It was trading at 40, 50, 60 times earnings multiple. And even right now, as of the most recent close, it's over 38, 37. But if you basically take into account the 17% sell-off that we're witnessing right now on a non-GAAP forward basis, 38 times 0.83, it's going to open at around 31.5 times earnings multiple on a forward basis, which 30 times earnings multiple is still a little too expensive, but the PEG ratio is going to be a lot better. From 1.96 is going to most likely drop down to like 1.5 or something. So let's just do that math very quickly. 0.83. We're looking at about a 1.6 PEG ratio, which on a growth adjusted basis is not that terrible. Of course, we want this number to be as close to 1 as possible, but it's a huge improvement from what we have seen in the past. The 5-year averages, of course, have been well over 50 to 60 times earnings multiple for Fortinet. And that's one of the biggest risks that I've talked about for a lot of companies is, a lot of these growth companies face a lot of multiple compression risk, right? If the growth rate slows down, the multiples will compress for these companies, which obviously is a big issue because that creates all these significant sell-offs and these gap down risks for these businesses. So going over to this type of analysis with a $1.25 billion in net income, 20 times PE multiple, and a growth rate of about 14 to 16%, we end up with an intrinsic value of $31 after accounting for some share buyback. We're looking at just about $33 per share. And in the past, my intrinsic value has been sub $40. So if you've been watching our channel for quite some time, in my previous videos of Fortinet, it's been under $40, right? My fair value. So this is really where we are. And I want to be as conservative as possible, right? Because we know that once Wall Street starts selling, it's going to overshoot to the downside like crazy. And even if they can grow net income by 14% over the next 5 years, considering that it's a growing TAM, and they dictate a 20 times P multiple, $33 is going to be that level. Now, if I increase that multiple to just say 22, now we're sitting at $36. 24, now we're sitting at $39.50. So it really depends, obviously on the growth rate and the P multiples, but I'm comfortable at a 14% growth rate and a 20 times P multiple, which does still mean that it needs to come down a little bit more. So let's say that it opens at around, what was it going to open at around tomorrow? We're looking at $47. So if we plug in 47 here, we're still looking for at least a 30% potential downside from these levels. Now, on a cash flow basis, things are a little bit different. So $2.2 billion in adjusted cash flows from last trailing 12 months, 10% growth rate, and discount rate of 12%, terminal growth rate of 3%, minus 1% in share buyback, and now we're sitting at $40 for the intrinsic value, and it's going to open at around 47. That means only a 14% pullback needed in order for this stock to be trading at its intrinsic value based on the discounted cash flow very, very quickly doing the discounted cash flow model. So based on those two models, I think 32 to $40, like that $8 range. I know it's a pretty wide range because there is going to be some volatility in that sort of area, is really what I would be watching for Fortinet. Like anything sub $40 is basically what I would be looking for this company based on the growth expectations we have and the price to earnings multiples and the discounted cash flows. And this right here is the overall technical analysis. So on the monthly chart, you'll notice that we have been on a very nice consistent uptrend of higher highs and higher lows. And it got rejected at this higher high and then started selling right back down. And 41.82 is going to be that next support level to watch. So this right here is going to be that level. So on the daily chart, you'll notice that that's the level that we have validated a couple of times. And that's exactly what we're going to be watching at $41.82. It's going to open somewhere around here tomorrow. If you do see some more acceleration, 10 to 11%, that's going to be the next support. Of course, the lower we get, the better. The lower the price, the lower the risk. And if you do end up breaking down, below this support, then anything sub $40, in and around these levels is where I would be considering Fortinet as a long-term position for myself in the cybersecurity space, because I still don't have any cybersecurity exposure. And I think Fortinet kind of fits the criteria of a lot of the things that I look for in terms of growth, profitability, margins, cash flows, share buybacks, balance sheet. Kind of checks a lot of the boxes. So anything under $40 per share is what I would be watching. Of course, technical support is going to stay right there for this company. So let me know your thoughts down in the comment section below. And what do you think about Fortinet? And do you own this stock? Are you buying, selling? What are you doing with this company? I would love to know. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below. Again, I did open up a few more spots if you're interested in joining us. Link's going to be down below. As always, happy investing. I'll see you all in the next video.